Good morning, ladies and gentlemen. Well, actually, there is nothing new in the risk dial. Although we are having a problem, as you can see, the scores are just being carried forward. But we know there is a fault. We're trying to rectify it. It'll be done sometime next week. But there is actually no change in the scores, so this is actually pretty accurate. We will advise you if there are any changes early next week while we fix it. I would have thought that this period will continue for a while, and we will examine what the yield curve and the bonds are saying at the moment. I've been expecting very little change in the yield curve. All we had last week was a small attempt at steepening ahead of the auctions, and as soon as the auctions were over, it was all undone. Net on the week, we didn't change, 1 basis point. So really, we are at the moment in a period of constriction of everything, which will then allow the big moves to happen ahead of Jackson Hole. So whichever tenure I look at, whatever part of the yield curve I look at, it's the same story. If we look at 530s, here this is a weekly chart. What did we change? Not even 1 basis point. This is naturally unsustainable, and if we go and have a look at it at a daily chart, we can see that really we've been between 121 and 114 basis points now for over a month. That will break, and at some stage we will get a big move in the yield curve. No one knows which way. My favorite way is a flattening, because every taper is a flattening move, but we will see if that is correct this time. I have no reason to believe that it's not. The one I keep on looking at is the 10s 30s, which basically keeps on going up down within a couple of basis points. Really, if 10s 30s now start breaking this 56 level, that will mean that inflation expectations are coming way down, and that will be the signal for probably a lot of flattening, and when we could go all the way up to here, but certainly to this kind of level, 42, 41, 42 basis points, and that would be a major indicator that the Fed is correct about their interpretation of the temporary, inverted commas, inflation. But one day at a time, 1 week at a time, and we will see what happens. As far as the individual tenures are concerned, we see the same thing in all of them. They're trading very well within the Bollinger Bands, and these bands are now going to be constricting. And guess what? I would have thought sometimes around Jackson Hole we will be not a million miles away from the 200-day moving average of the yields. That is where the market likes to go ahead of all big events. And so we know what the top is here. Between 79 and 85, it's going to be very hard to break through, and absolutely no way are we going to be below the moving average, which is going to be somewhere around 68 by the time Jackson Hole comes around. So that's the 5s. The 10s, much the same story. We can enlarge this. We can see that the Bollinger Bands are now going to constrict. The market is going to be somewhere around the 200-day moving average, which is going to be right here around 130 basis points. So I would have thought, what do we have now? 10 days or so, 10 days of going sideways, probably between fill this gap, 122, back up to 129, i.e. basically going sideways. If we look at the 30s, this is getting to be slightly more interesting because we've done two things which We've tested the 200-day moving average from the downside, failed. We will probably come down to this 191 basis points, might fill the gap, but really in 5-6 days time, I still expect us to be somewhere around here. What I found interesting and probably significant and a bit of a tell is the fact that we bounced off the moving average, which is headed upwards. And this is TLT, which would indicate that at some stage we get a move in TLT back up towards the 160s. That is definitely flattening. And I think flattening is going to be good for the risk markets, but who knows why the flattening is going to take place. What the Fed is going to do, who knows, one week at the time. But I would have thought that the fact that everything is constricting is actually going to cause volatility once we get to Jackson Hole. In Europe, we had a very quiet week. We tried, this is the bobble, we tried to go up into resistance here around 68, which I would have loved to have seen because I'm short of bobbles still. But we failed. And really the fact that we can't really do much better than 4 basis points from the best levels that we had indicates to me that the market is very much short of bonds, not short in the sense that people are position shorts, but that there aren't enough bonds out there, that the ECB is hoovering up absolutely everything. And if we look at the bonds, you can see really that what have we moved? What were the worst level? -50, and we're -46, and we were at -44. That is pathetic. I expected more. And even the peripherals in Europe, if we look at the OAT, which is trading very clearly, it just cannot break through this -0.09 basis points. Every time it gets there, they're buyers, which indicates to me that this is going to be some kind of a bear flag and that we're going to fall down to -22, -23. And really, if we have a look at Italy, it's much the same story. You can see how, if we enlarge this period, the Italian bond had every chance to come back and test this kind of level around 72. Did it? Absolutely not. It's within a couple of basis points of the all-time lows. Not all time, sorry, but the lows that we had in the past couple of weeks. And if we look at the relationship between Italy and Germany, this very much tells me this stability, very much tells at lower levels, very much tells me that the market is looking for yield. And it really wouldn't surprise me at all to see a breakdown to around 91, 92 basis points at some stage. So I will definitely be covering my bubble in the next couple of days. My bubble short, I see very little point in being short. All this indicates to me that with all this talk about inflation, etc., is just not being, the tell is that it's just not being reflected in the yields. The fact that we can only move 3, 4, 5 basis points off the lows tells me that there aren't enough bonds in Europe, and that looking for much upside is going to be unrewarding. Now, the one thing that is pretty obvious is that if it's going to be unrewarding in Europe, it's probably going to be unrewarded in the US as well. I would have thought that at Jackson Hole, by the time we get to Jackson Hole, the market will be around where we are now, 175 basis points differential. Every time we try to get up to in the 180s, 181, 182, we get smacked back and we trade around 175. I would have thought that is, where we are going to be around Jackson Hole. Everything is going to constrict around the important levels, and the markets are all going to be at very, very important levels, constricted, ready for an explosion after Jackson Hole. Whether we get it or not, who knows? But that is what the markets are doing, and it makes sense to me. What to say about DXY that I haven't said before? I think the levels are so clear now, aren't they? It keeps on trying 93.14 and it keeps on failing in 93.14, and then it gets broken down. Where is it going to be around Jackson Hole? Probably a little bit lower than this, but not very much. As you can see, everything is constricting. Everything is saying that that is going to be a very important event. If we look at the dailies instead of the weeklies, you know, it's interesting that we are stabilizing on the 200-day moving average. It's now beginning to turn up, only very slightly, but you know, we will constrict, we will remain in this range, and we will be ready to break out in both the DXY, and also if we have a look now at a chart of Euro USD, same story. You know, the 200-day moving average is beginning to peak, and even the weeklies are beginning to turn, as you can see by the constriction here of these moving averages. 119.5 to 120 is going to be absolutely very, very difficult to break in the next in the next 10 days of trading, or 7 days of trading, whatever we have ahead of Jackson Hole. Don't expect any more. I would have thought that 119.10, that's to me as far up as it can go, and really await Jackson Hole at those levels. Well, gold was an interesting one, wasn't it? We got our spike down on Sunday night. You know, I guess there was a complete washout of positions. Whoever had a stop got stopped, you know, to below 1700. And then we actually spent all week going back up 1764, where we closed pretty much on the highs of the week. But nothing really has changed. I would have thought that the downside is still the weaker side. The 200-day moving average keeps on getting more negative, and if we enlarge that, we can easily see it. All the moving averages are getting, you know, more negative. The Bollinger Bands are constricting, but really, until you get up and close above 1837, 1840, nothing has changed here. The downside remains the weaker side, and who knows why. We will know once it happens, but really it seems to be very much in a trading range at the moment, with the levels that I gave you on the downside around 1700 as the lows and 1840 as the high. Everything is constricting. Whichever market you look at, the Bollinger Bands on the weekly and the daily are constricting, saying that we are coming up to a seminal event, something which is going to be very, very important for a long while. You know, there is no need to anticipate when that happens. It's just important to know what the break levels are and then go with them. I keep on saying that DBC is a better long than gold, and with some reason. While gold, you saw, broke the 1764 level on the downside, got washed out all the way to 1700, DBC couldn't even break into this 1868 to 1841 range, straight back up. Look, everything is converging on the Bollinger Bands, and finally the MAs will start catching up. So really it's saying another couple of weeks of stability ahead of Jackson Hole without much doubt. But it keeps on holding levels much, much better than gold does. And that is why I prefer to be in DBC rather than gold. And the fact that we are also holding against SPY is also another reason why I think that DBC is going to do better longer term. On a daily chart, basically we're holding the upper trend line and we're allowing the 200-day moving average to catch up. If you compare and contrast this to what gold is doing, DBC is making a strong move with the moving average, while gold's moving average is turning. Everything is telling me that DBC is a better risk. If you want to have something which is not risk related, as an inflation protection play or whatever. I have very little in DBC or in gold. I'm way far more exposed in risk assets, i.e. equities. But if you're going to have one of these, it has to be DBC rather than gold. At the end of the day, they say the trend is your friend. And as you can see, SPY over GLD actually closed almost completely unchanged on the week, as it did against TLT. So really, nothing happened in the allocation between equities, gold, and bonds last week. They all came back. Although they had, especially gold, a big range, they actually came back right to where they started the week. So really, we are stuck in their relationship, and we probably will be until Jackson Hole, without a doubt. As far as equities are concerned, it's really a tale of two cities. One where we have SPX and NQ to some extent, and Europe, and the other where we have every other market in the world. SPX, everything is clear as long as it's above 44.26. We are in a nice, gentle uptrend, which basically continues all the way to 4,500. As I told you, JPM are right. 22 times 205 gives us what, 4510. So 4,500-ish is where this is slowly heading, but also setting up itself for disappointment, because I'm absolutely convinced that over the course of the next 10 days or 2 weeks, at some stage we retest 44.26. We always retest these levels. It's as simple as that. While it's above 44.26 and keeps on closing above 44.26, there is absolutely no reason to start getting worried about SPX. As far as NQ is concerned, it's running out of steam. It's very easy to see that it's running out of steam, but it's basically supported at levels. To me, 14,992 is still very, very key on a closing basis. We've just failed to close below any time last week. Yes, we just couldn't do it. We just kept on bouncing off that area. Each one of these bars is half a day, so 2 a day. We just could not break below 14,992 and close there. Every time it got bought. So, stability, and really at these higher levels, everything is constricting, and everything is telling me that we will get a big move. It's just not yet. And what I like to see is that all the spreads between tech and say XLF and so on have done exactly what I thought they would do. And I bet you that by the time Jackson Hole comes around, they will be around the moving average. So, it just says stability for the next several days. And technically, that is going to be preparation for a big move. If we have a look at the Qs against SPY, where's it going to be? It's going to be right here, and ready to break either up or down according to the result of Jackson Hole. I would have thought, don't forget that if I'm correct and the yield curve, the move, the eventual final move in the yield curve is to flatten, that should actually favor the Qs over SPY. But that is just, wild speculation, and I don't put on positions on the back of wild speculation. I put on positions on the back of facts and technical movement, which confirms them. The Russell is beginning to be more and more interesting, and I'll look at it through in various time frames. Now, the pieces are not there yet, because if I'm expecting a flatter yield curve, that actually should be bad for Russell relative to NQ especially. But the levels are very, very clear, and this is IWM, 211, 234 and a half. It's been in this range now for months, since February. And if we look on a daily, we can actually see what that is like. It's basically allowed the 200-day moving average to catch up. And, everything is now constricting, contracting, and we are basically saying that a big move at some stage of this area is going to happen and is going to be sustained. And I keep on saying, if I'm right and the yield curve flattens, that should be bad for Russell. But everything is actually on this chart is telling me that at some stage we break up. So, that's why I'm saying the pieces are not coming to me. All the pieces are not in place. And this is a monthly chart. And as you can see, that basically we have done absolutely nothing in the Russell for what? We are at the same level as we were here. So 1, 2, 3, 4, 5, 6 months of zero activity, of zero net movement, pardon me. And that is going to change at some stage. And when it happens, it's going to be very sustained. But again, I don't know where it is, but I have my eye on it. I have my levels, and I know what to do. Well, as I said earlier, we have a tale of two cities. We have SPX and stocks, and then we have everything else, and EM, which this is, falls into the everything else. It's in fact probably the weakest. So basically it's hogging the Bollinger Band on the downside. I would have thought that at some stage it's going to, this is an ABC and these are the retracements. We are looking for this area around 48 at some stage. No idea why that is happening. Well, I have ideas why, but I would have thought it would have been anticipated wildly up to now that EM, and it would be in the price, this coronavirus thing in EM. But as you can see, it's really breaking down against everything in terms of spread. This is even the Nikkei. As you can see, could it come down to here? Very easily. And this is against FEZ, which is basically stocks. And as you can see, it's breaking this very important level that it's been trading around for a long time, and that says that it could come down another 3, 4, 5% without any problem. And as far as SPY, well, as I kept on saying a couple of weeks ago, EM, no point, go for SPY. It probably still has another couple of percentage points in it, which basically puts Nikkei right into the middle of things, and it can't go one way or the other. We closed the week, as you can see, within nothing of unchanged. And that is also more or less hugging this lower Bollinger Band. To be fair, it's allowing all the moving averages to catch up with it, but we keep on trading around this 200-day moving average and not being able to be sustained, and not being able to sustain the really important levels like 28,180, 28,335 on the weekly. We just don't sustain them. We get there, we spend half a day there, boom, straight back down, which shows to me that the only two contracts which are showing strength for now are SPX and stocks. And stocks is definitely leading DAX. You can see what stocks did, basically higher, 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 higher. There are buyers of stocks, there are buyers, very big buyers of calls. There you go. We've now closed up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days on the trot. But we have definition, and we have the very important level 41. While it stays above there, and I certainly expect it to do that kind of thing, there's nothing wrong with stocks, and just like that 44.20 odd level in SPX, there is nothing wrong with SPX. DAX, it's becoming, it also broke higher on Friday, and really this kind of level, between 15,711 and 15,790 now becomes critical. As long as we don't go below there, the market is in good shape. So, tale of two cities. Europe and US mostly are okay. Everything else is feeling as weak as a kitten and really not doing very much. The VIX is at very interesting levels. This is a daily chart of the VIX. To give you context, it trades in these channels, doesn't it? Between 15.5 and 20, and then 15.5 and 12. It needs several days below 15.5 to confirm anything, because all this is a little bit below. I mean, it's like not significant. All it's really done is fill this gap here several weeks back to beginning of July. I don't think we will await Jackson Hole below 15. I think we're more likely to be around 17, 18 by the time Jackson Hole comes. But that's basically what is happening in the VIX. And if we have a look at a weekly chart of the VIX, it's basically very, very clear that, this contraction of the Bollingers will not stand. At some stage we will make a significant move, and it'll either be all the way down to around the 12 area, or I think it's going to be 2250 quite easily in the next couple of weeks. All of which brings us to this week's summary table. I've changed some of to make them more precise, some of the levels. The one that I would be interested at some stage is the VIX, because the yield curve is very, very steep, and that's why it's very difficult to get long of it. But this Wednesday we have the expiry of the front month. We could get the second month, when it becomes front month, to come down quite a bit. So I'll be interested in looking at some VIX spread call plays. I'll naturally tweet those to you. But otherwise, I think it's going to be a quieter week, probably one of profit taking, but not very deep. I would be shocked if SPX goes below 44.26. I think it's going to be the kind of week where people are taking more profits just to reduce the level of risk they have. They get the market to interesting levels, buyers resurface, and up we go again. a contraction, a general contraction of the trading ranges, and getting people positioned and ready for bigger moves the week after next. Thank you very much indeed, and naturally tweet you on Monday.